Today, perhaps the bear trap has been set. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. And just before we start, a quick reminder that tonight at 8 p.m. Sydney time, I'll be joined by Damien Klassen in my live stream event, and we're going to focus specifically in on the current market dynamics, what's happened, and what may happen during the year. So mark your diaries, and we'll see you this evening. Well, a surprisingly good start for the US stock market in 2023 is likely to fade this week as the Federal Reserve is set to announce its 8th consecutive rate hike at the conclusion of its policy meeting, according to Morgan Stanley's Michael Wilson. We think the recent price action is more a reflection of the seasonal January effect and short covering after a tough end to December and a brutal year, wrote a team of strategists led by Wilson, Morgan Stanley's chief equity strategist. The reality is that earnings are proving to be even worse than feared based on the data, especially as it relates to margins. January started on a high note for stock market investors, with three major equity indices at pace to book strong monthly gains. The S&P 500 was down 1.3% but up 4.6% in the first 4 weeks of January, while the Dow Jones advanced 1.7%, and tech stocks have had their best January in decades, with the Nasdaq Composite, though it dropped 1.96% today, up 8.9% on the month as of Monday, on track for its best January performance since its notched a 12.2% gain in 2001. However, Wilson and his team were surprised by the magnitude of the recent advance. It is just another bear market trap, and all the good news is now price, which means the reality is likely to return with month end and the Fed's resolve to tame inflation, they wrote in a Monday note. The January effect is a seasonal tendency for small cap stocks to rally in the month following December's tax loss harvesting in generally illiquid equities. Theoretically, investors could use those funds to rebuy new positions in January, which can contribute to the monthly rally. Other possible explanations include window dressing, a practice performed by institutional investors to buy more shares of top-performing stocks by the end of the year to improve the appearance of their fund's performance before presenting it to shareholders. Another is investor sentiment, with investors tending to be more optimistic about the future as a new year begins. Morgan Stanley strategist warns at the start of the year that a recession shock in 2023 could drive another 22% drop for stocks, and they expected the large cap index to finish the year at 3,900. The S&P 500 ended 52 points lower, or 1.3%, to 4,018 on Monday. Moreover, Wilson argued that investors seem to have forgotten the cardinal rule of don't fight the Fed. He said the upcoming FOMC meeting, which concludes on Wednesday, will serve as a reminder the central bank is widely expected to raise its target Fed funds rate by 25 basis points to a range of 4.5 to 4.75%. And traders have now placed a 98% probability of that size of hike, according to the FedWatch tool. So far, however, the Fed has yet to signal a willingness to hit the brakes and truly pivot to a more dovish stance. That, coupled with the reality of the worst earnings recession since 2008, are being mispriced once again, in our view, said Wilson. Morgan Stanley's 2023 base case forecast for the S&P 500 earnings per share is $195, while their bear case forecast is $180. EPS, of course, refers to net income divided by the number of shares outstanding and could indicate how much money a company makes for each share of stock. Wilson and his team say they are now leaning more toward their bear case of $180 based on the margin compression. We think it's important to note that typically when forward earnings growth goes negative, the Fed is actually cutting rates. That's not the case this time around, which is an additional headwind for equities. So fasten your seatbelts and expect more falls ahead. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.